Live streaming is on.
Ladies and gentlemen, it is that time again to host our trader strategy meeting. We have the market trading very close to the session highs. S&P futures trading at 44.63, and again we are trading near the top of that opening range. So it's as good a time as any to bring in our trading team and get an update as to what they're thinking. In case you're new to the service, we host these meetings usually about once a month, and we talk about what the trading team may see developing over the course of the next several weeks. And so that means we're going to bring in chart trader, trend tracker, blue chip trader, and scalp trader. We'll be missing event trader today as he will be traveling, but we got our team almost fully assembled. So we are going to welcome in Brett Manning, and you know him as Chart Trader. I wish you a good morning, Brett. How are you?
Hey, I'm doing pretty good, Jim. How are you?
I'm doing all right. We had to postpone this meeting for about a week as we had some glitches going on, but I'm glad to have everyone back at it today. My first question for you, Brett: are you a poker player at all?
Once upon a time, but not for quite some time.
Texas Hold'em guy?
Five card stud.
Yeah. All right. Well, I'm going to use a little Texas Hold'em analogy for you.
All right.
All right. So here we go. We were dealt our first hand in 2022, Brett. And since you're under the gun, I'm going to ask you this question. We got our first look at the cards, and we got our correction. Right, that was our first uh, week or so of 2022, and then we see the flop. We turn it over. We get the FOMC. Then we get the mega cap earnings. Then we turn over the river. We get the jobs data, and lo and behold, if we were to put another card out there, I guess it would be the geopolitical tension. So, with all that said, Brett, where are you placing your bet? You're under the gun.
Right now, I'm not placing bets.
You're checking.
So, well, what I'm telling you right now is I've had the last few weeks have been very good for me, and Friday was exceptionally good. And then we got this escalation in Russia, and I got the sense that we are just, completely enmeshed in that headline minefield kind of situation right now. That right after a string of really positive trading results, I'm not too eager to place a lot of aggressive, especially intraday bets until we see some more dependable resolution there. Because really, you're in a market where you can have no conviction in a position because a second later, a headline can come out and change things. And you know that everybody else is in the same position. And when you have a market where nobody has any conviction and everyone knows it, pattern-based setups, and which is really my stock and trade, especially for intraday stuff. Pattern-based setups become truly meaningless because a lot of the wiggles in there are just sort of cascading processes when people think something's changing, and they get over levered and then they pull it back. And when you see people start to pull something back, people think, oh, it's another headline hitting, and it cascades into an event that was really nothing, and it just comes right back into the middle. But that all kind of is part of the construction of these patterns that are so important for me for setting risk, for deciding, where the tape is really leaning under the surface, and it becomes a much less dependable game for me. And so I've learned over time when we get into a situation where, particularly with geopolitics, where you've got the market really everything changing every hour or two based on some new development related to some kind of specific headline theme. It's just an unproductive environment. And again, I'm coming off a really positive string, and I'm just not too eager to be placing a lot of bets inside of that context. I've got several open positions, and I'm content to let this resolve itself.
All right. So, what might be some of the scenarios that would get you interested? I was talking to Carmine yesterday, for instance, and he said that he thinks that the window of the potential for any type of escalation, invasion, what have you, is probably between now and the middle of March.
I heard that. Now, why did he set that deadline?
I think because of some of the commentary that he's heard, he doesn't want to Putin doesn't want to disrupt anything with the Olympics.
Well, I mean the end date. I'm more curious. You said something about frozen ground. I didn't hear the
Oh
beginning
yeah,
of it.
so I guess there was a comment a week or two ago that they were waiting for the ground to freeze over, and that makes it more.
Because it's
I
what,
don't know.
marshlands or something?
I think that might be the reason.
Okay.
That was my interpretation.
Yeah,
Uh,
I heard the end of your conversation with him, but I didn't understand where they came from, and I suspected maybe that's because of marshy areas, but
yeah, and that was based on a comment from a couple weeks ago, if I'm not mistaken, that the I can't remember who said it, but there was
okay.
somebody out there who said that they'd be waiting for the ground to freeze over, and that would be the ample time for them
Right.
to do
Well,
an
and
invasion.
I would also assume that, natural gas prices are through the roof and it makes Germany have a more difficult time kind of willing to risk losing their access to natural gas because it becomes effectively a gigantic sanction on Germany
Hmm.
if we take it to the next level. So I would think it gives Putin an extra chess piece if it's the middle of February when countries that are going to be key to making the decisions on the other side of the table are like Germany. There's glaciers in Germany. It's the middle of February. They need heat, and
Right.
all that heat is coming from Russia. So there would seem to be more leverage in the middle of winter in those terms as well.
Yeah. Well, and then I guess mid March would be closer to spring. I assume they're on the same type
Hmm.
of seasonal schedule we are.
Right.
So, all right, Brett. So anyway, talking about the energy markets, what are you seeing in crude oil lately? It's been really ramping up. Some of the data is the data jiving with what you're seeing in price action?
Yeah, so I mean, I continue to sit long oil, and I continue to believe that we're in a major oil bull market, and it hasn't reached any kind of extreme. Obviously, the Russia-Ukraine situation has added some juice to that trade, and you can see how reactive it is to headlines there. But positioning in that market's nowhere near an extreme still. It's only about 400,000 net longs in CFTC data, and that's nowhere near where we get to oftentimes in serious peaks when you have too many people piled in. In other words, it's not a crowded trade. And we keep seeing inelasticity on the production side. Price moves up. We look at how many new rigs are being deployed and how much they're really doing. Really, there's not a lot of increased production, even as prices moved considerably higher. I mean, really, we were in the 60s, now we're in the 90s in just a few months. So you've got reopening of the economy when you start to get past the pandemic. There's all sorts of figures in there. There's one other point. We just saw something from Vitol Group, which is the world's largest independent oil trader. They just put out a note about a week and a half ago saying that their measures of Chinese stockpiles for oil are basically rock bottom. And typically, when China does restocking of a major commodity, they do it just after the Lunar New Year. That would suggest right now we're starting to see maybe some big bids coming in from China restocking the oil reserves, and that could be an enormous factor as well.
Mm.
So if you got inelasticity on the supply side, people aren't producing much more when the price goes up, and then you get another big buyer coming into the market, regardless of how the Russia-Ukraine situation plays out, I'm perfectly comfortable remaining long oil.
And that's via the USO, right?
I'm in the USO. I wanted there's an actual tactical advantage right now to being in the USO versus the futures when you have to roll those contracts because the USO because there's what's called backwardation in that
Hmm.
market right now as future contracts are priced below current contracts all the way across and for more than a year out in the future. The way that USO works is it rolls its exposure and it adjusted its policy in the middle of 2020, but it's still rolling from one contract to the next, just at different points in the curve. And so, if every single one of those points in the curve has the next contract pricing lower than the previous contract, they're constantly going to be buying low and selling high every time they roll. So the USO actually outperforms the price of crude oil over time. It does the opposite when we're in what's called contango, when every next contract is pricing higher than the previous contract because it's buying high and selling low, every time it rolls contracts. So
Mhm.
you tend to see that's why USO on a very long-term chart looks so much worse than crude oil, which is near its highs of 7 years ago, and USO is nowhere near that because most of that time crude oil was in contango. So USO is underperforming it. But over the last year or so, we've seen it shift into steep backwardation. And that's another sign of being in a true blue bull market in oils when you see backwardation. And that actually means USO will outperform the price of crude oil. So it's a reason to be in USO versus being in crude oil.
Okay, and you're also involved in GLD, if I'm not mistaken. So inflation hedge.
So really, all right. So the story there is when you take the Russia Ukraine, that escalation was really Friday afternoon, Russia, and before that it was all about inflation and the Fed. And we had the Bullard comments on Thursday that knocked the market down, and we've got a situation now where Wall Street's looking for 6 to 7 hikes this year, decent chance of front loading by starting like a double bubble hike in March. And the big issue really around all this is, and why this is angst, and why we saw pressure in the market before the Russia stuff, is really because there's a growing sense that the Fed may already be so far behind the curve that it's missed the potential to have a soft landing on inflation. That, in other words, they don't want to have inflation for 25 years, and so they have to break its back, and that may mean they have to break us into a recession in the back half of the year. And that's the reason why the market has been weak. It's not Russia. It's not just a hike or two. It's the idea that the Fed may have gotten themselves into a bind where basically they're going to need to break the cycle to break inflation expectation growth. So that's the narrative. However, at the same time, right now we're starting to see, I believe, the conditions precipitate the possibility that doves on the Fed are going to start to get a little bit louder because we've seen such a fall off in the virus data that you're going to start to see a big pickup. Spending's going to shift from goods to services, and that takes pressure off supply chains, and then supply chains themselves, because of reduced regulations around the virus, are going to get a little bit more efficient. And this has always been the sort of vision of what we call at the Fed team transitory. So team transitory's big narrative is that at some point all these pressures are going to ease organically, and the Fed wouldn't really have to hike like crazy because you're going to start to see spending shift from goods to services, and you're going to start to see supply chains smooth out because of a lack of being such preoccupation with virus regulations and lockdowns and et cetera. So as so I think they're going to be able to start to see around this corner when you get post Olympics in China, because China, it's widely believed, will start to shift away from having this zero COVID policy where they're trying to stamp out every single viral transmission. Once you get past the Olympics, if they start to do a manage and mitigate strategy like the rest of the world, their wave flames out as well. Supply chains open up, and you get this sort of big headwind to further inflation growth. I think the Fed likes that story. I think there's a lot of people on the Fed that like that story. But if the Fed starts to push back, if the catalyst for gold is seeing the Fed come out and say, you know what, we're not going to need to hike 6 or 7 times this year. Inflation's probably going to fall back to our target rate without us doing more than 2 or 3 hikes. I think we might start to see messaging like that around the next corner. And what that's going to do is that's going to force money managers to carry more gold, because the Fed may very well be wrong, and this is just a narrative that allows them to fall even further behind the curve. And you have to hedge against that risk. And there's one tried and true historical way to do that, and that is to increase the amount of total gold that you're carrying versus cash in this case. So you see that, maybe a 5% of holdings shift in a lot of major fund managers from cash to gold upon the Fed getting a little bit less hawkish. And I think that that's what can finally break gold out of this sort of 2 year long sideways consolidation. So I fixed them up. Then we got some juice on the Russia stuff on Friday as well.
All right. And any reason why you chose the GLD versus the futures?
Yeah, because we're in the front half of the year and there's just a million contract rolls coming up. If we were past August, I probably would have been in the futures. The contango and backwardation are not really a factor for gold. So really, at this point, it's just the simplicity of holding GLD if I think it's going to be a multi-month trade rather than having to constantly worry about contract rolls. It's the same result. It's not really going to make a difference in terms of the performance of the trade. It's just easier to manage when you know when you believe you're going to be in it for more than a month or two. And again, if we were in the back half of the year, the way the gold market works is once you get to the August contract, you roll to December. So you're in one contract for several months. And typically when we get to the back half of the year, if I'm trading gold, I'll just take the futures.
Got it. So because you're in this longer term trade in gold, there's really not a need for the overnight risk or a stop that you would have in the futures.
Not with, I'm small and wide on it. So this is not a highly aggressive position.
Okay, got it. I'm going to bring in Trend Tracker and get his latest view on the macro dynamics. I haven't talked to you in a while, Craig. How are you?
I'm doing well, Jim. How are you?
I'm doing quite well. It's good to talk to you again. And as far as where you are from a macro perspective, you've got names all over the place. So what are you looking in? And then we'll just dial into some of the more specific names.
I guess my view on the broader market is mostly unchanged from the last meeting. The Q4 earnings season was strong. I think in aggregate, in the S&P 500, they grew like 30%, about 30% in Q4. And from the bottom up perspective, obviously inflation is the big risk, but things look okay. From a top-down perspective, they're a little bit more precarious. The market's still trading at about 20 times earnings, about 13 times EBITDA, which is historically quite rich. And with the Fed focused on fighting inflation, it's not necessarily a great backdrop. So, I'm still sort of expecting a sideways to maybe downward market here near term as inflation pressures and the Fed are the main risks and concerns. I've only started one new position so far this year, and that's in D-Low. D-Local, I trimmed half of it already because it saw a nice bounce. And I've added to positions Pubmatic, PUBM, Roblox, RBLX, Upstart, and kind of lowered my costs a little bit in Airbnb. I have a half-size position, and those last three all report this afternoon. So,
so your actual strategy will probably adjust based on some of the earnings updates.
Yeah, I mean, I'm in all of these, more so as an investment, right? I'm sure you've seen I haven't been super aggressive in buying things these first 6 weeks of the year, even though a lot of the growth stocks that I follow have been decimated. I'm obviously going to be watching these earnings. There's a bunch out this afternoon, and then also TTD is tomorrow morning, which is another one of my big core positions. I'm the most attractive setup into tomorrow morning is probably TTD, but based on what we've seen over the last 2 or 3 months, a lot of the stronger reports, even if they had a good day or two, have ended up getting faded. So, I'm not in a rush, and I haven't been super aggressive adding ahead of the prints, as the subscribers know.
All right. So you must be reading my mind because that would have been my next question. Which one looks most favorable heading into the print? And that would be TTD. So any other
Yes.
update that you have? What's brewing in the lab back there?
Well, like I said, I only started one new position so far this year. And I do have plenty of positions that I can or will be adding to at some point. I've been focused more on managing current positions than looking to buy anything new. So, it is going to be a very busy afternoon. Should I just touch on each of these?
Yeah, please.
Earnings this afternoon?
Mhm.
So I guess I'll just start with TTD, which is actually tomorrow morning. It is probably the most attractive setup, all things considered. But at the same time, it's not cheap at 60-something times EBITDA for next year. So is there a risk that we see a sell the news reaction to beat and raise Sure. But, if you look at it from more of a top-down perspective, it's a $36-ish billion company. And it does, over the last few years, the reason that the stock continues to receive so much love is that it does have a position, does have the potential to become, one of the next big players in the ad space. I mean, there's a clear big three now. Everybody knows about the duopoly: Facebook and Google. Amazon is the third biggest player. They finally broke that out last quarter. The Trade Desk's revenue and the advertising spend on its platform is still a fraction of those guys. But there's nothing stopping this company from being able to take share and grow 30-40% plus over the long term. So yes, it's optically expensive if you look at the 22 numbers. I do think the company should be able to report another beat and raise, but big picture, I think the stock still has a lot of upside long term. So I was kind of tempted to buy here on Monday when it kind of pulled back into that either Friday afternoon or yesterday, around 75. But again, I've been more generally cautious. I do like the setup into the print. Maybe a call spread would work. The options are very expensive because this thing made a huge move to new highs last quarter, and now multiple compression across the board is kind of taking it back down. So I do like that one a lot. The other probably most interesting one is Upstart this afternoon. That's UPST. We had a lot of success in this stock last year, and it's fair to say this stock should have never been at $400. But we were kind of in and out after that first blowout. I think it was last March, their first quarter as a publicly traded company. And we were successful in kind of just buying pullbacks and riding this thing because they just had a massive year. So the guidance, I think, is going to be more important than the quarter itself, potentially. Obviously, they're going to need to report a strong quarter as well. But, this company took massive share, growing well into the triple digits last year. But now all of these macro tailwinds that the company was enjoying are pretty much gone. And a lot of it is turning to potential headwinds. So we're going to see how much of last year's insanely strong numbers were more a result of macro tailwinds, or if the company really is differentiated and able to take share in the unsecured personal loan market. They have a huge potential in the auto refinancing market as well. The expectations for next year, I think it's up to like 50% now revenue growth. It was closer to 40% a month or two. EBITDA margins are expected to come in a little bit. But with the stock back here towards $100 a share, it seems like a great opportunity for the long term. Now, if they do guide down, the stock could get hit pretty hard. We've seen a lot of fintech blowups here in recent months, especially. So if they do get guide down, and let's say it's maybe just a little bit, as long as it's not like a total disaster, the stock could get hit, and I would probably view that as a buying opportunity, because this isn't just like an Affirm buy now pay later model where it's basically just looked at as like a subprime lender in a new way. I do believe in this company's proprietary model, but they are dependent on repackaging loans and selling to Wall Street. They are dependent on the capital markets. So it's going to be a dicey one. I have slowly scaled back into this as it came back from those astronomical levels, 300-400 plus. So my cost is, I think, about 10 or 15% above right now. But this one is going to certainly be volatile near term. But I do think that this is a really attractive story, and the valuation has gotten pretty attractive too, because they are profitable. It's about 40 or 50 times earnings here, if they can guide in line. So I think the options are pricing in at 25-ish% plus move by the end of
Wow.
the week. So this one is going to be very interesting. I mean, they've done nothing but blow it out every quarter, and the stock has gone up until last quarter. I mean, but the stock clearly got ahead of itself, and now we are in a different world than we were during 2021 when money was free everywhere and stimulus checks and all that good stuff. So
Right. So I'm curious. What's their commentary on how the rate cycle impacts their business?
well, they have planned for higher delinquencies and charge-offs, right, as the credit market normalizes. So it's not like it's not going to be a shock when the performance of their loans gets a little worse, and that's been kind of one of the bear arguments over the last few months, is that delinquencies in some of their loan portfolios have ticked up because there's public data on that. But again, management expected that. I mean, we all know that 2021 was an abnormal year, so higher rates in themselves, it's not going to kill demand for personal loans.
Mm-hmm.
So unless the economy really just kind of falls off a cliff, of course it's going to impact their demand. But I really like the company's positioning. I mean, there's certainly bears that think this company is just a joke, and the whole fact that they have their own AI models that are disrupting the FICO model it's all just a farce. But the company showed last year that their business model can really blow up in the right markets. And obviously, you're not going to have as many tailwinds this year, but I think it will show some staying power in a more defensible way than something like a firm.
All right. Now, Airbnb has been moving well today anyway. So is that a precursor to some of the things that we're going to see? We had Gavin talking earlier about these type of names, travel names, airliners, and names like Airbnb. So you expecting big things?
Yeah, I mean, as I'm sure you know, the travel theme is one that should have some staying power here. I mean, travel's on fire. I think it will remain that way, and this is kind of its own disruptor category in a leader within the travel space. So this stock is not cheap, and expectations are high. But there's been a couple of recent downgrades based on, over the last 2 years, there's been a lot of people staying on Airbnb for a month or more as they kind of work away from home on longer vacations, and that has benefited their pricing. So if that kind of normalizes, that will be a headwind. But that is a short-term concern that could play out. But all things considered, if this stock does get hit and go back down to, below the 200-day, 150, 140, I would still view weakness as a buying opportunity for the long term, because this company is likely to grow profitably for a long time. And, when this thing IPO'd about a year ago, it came out at a really rich valuation, but it's already kind of grown into it. They're not spending nearly as much on marketing as they used to. So they're expected to, I think, do about 1.5 billion in EBITDA 2021. It's going to be 1.85 billion is the estimate for this next year, or for 22. Brian Chesky has shown to be a pretty solid leader. And again, in this new world with such high demand for travel, this is one of the more attractive stories. I view Airbnb along with Unity as, I think they were both December of 2020 when they came out. Just really, really attractive long-term growth stories, and yes, you're paying up for them in a way. They're not cheap stocks, but Airbnb at least is profitable, and if they can just continue to attract more supply, people willing to rent out their units, their housing, then the growth outlook for the long term should be very strong. So, I mean, the expectations are high here. Will this? I mean, sure, they could report a blowout, and then this thing could jump over 200, but I'm not necessarily expecting that. I am just I view it as a investment where I will look to buy weakness. So,
All right. What's your cost on this one? Your average cost?
it actually just came down a bit because I sold a little bit above 160, and then I got stopped out below 160, and then I added below 150. Hold on 1 second here. My cost is about 153. So,
All right.
I mean, I'm probably not going to add, above that, but if the Nasdaq remains under pressure, if they don't really blow it out, there could be opportunity to buy this again when it's out of favor. But demand should be really strong for at least the intermediate term in terms of travel. So this is one of the ways to play that, obviously. So.
All right, let's shift gears a little bit. Blue Chip Trader, welcome back from your vacation. I know the community missed your activity, and you're back at it again today. So how's it going, Blue Chip?
It's pretty good. Pretty good.
All
Just
right,
trying
so
to get
you're
back in the saddle, updating charts, reading through emails, checking my trend lines, resetting my alerts, typical daily trading stuff, but trying to play catch up after a week off.
I hear you. I don't know if you saw, I know you mentioned SPCE. I know that's a name that you were trading quite a bit. And did you see that they are going to be opening it up to the public? Are you first in line?
Believe it or not, I'm afraid of flying, so I don't like that. But I won't be in first in line. But I'm sure plenty of people would enjoy it. So yeah. But needless to say, I haven't touched this stock, man, probably since last summer when it was getting all those volatility spikes above $20, and it ran up to as high as like 52, 55. And then after that momentum died out and price action fell back below all the moving averages, it's really been off my radar for the last 6 to 8 months. And saw the headline today. I saw a couple of my scans show a pickup in volume, the breakout over $10, a nice psychological level is in play there. So they're going to offer tickets tomorrow to the public. I have no doubt that there's a lot of people who are going to be online to pay for it. I didn't see the actual price. I don't know how many people are going to be able to afford it. But I would imagine there's going to be a mass amounts of, people who are well-to-do who are going to be online. So to
Yeah, I would
purchase those
imagine.
tickets. Yeah. Do you know how much the tickets are? I didn't actually look.
Craig says 450,000.
Yeah. So every celebrity, athlete, and every other, major, business owner and everybody else in the world is going to definitely take a shot at it. I think at some point, outside of their, Caribbean vacations and stuff like that. So it'll probably do pretty well, is my guess for initial. But technically, it's really intriguing because it did break that multi-month downtrend line, and it also broke weekly resistance around $10. Again, I wouldn't say it still seems like a crapshoot to me. It still seems like it has to prove itself, but this is a strong enough name that if you want to just dabble, treat it like a lottery ticket, buy a little bit. I wouldn't really dump your life savings in it or anything else like that. I'll just kind of buy it, hold it above this $9 area from which it just broke out, and roll the dice with it. See if you can get a little bit out of it to the upside as the momentum starts to kick in.
All right. So you have a fairly good track record of identifying some of these movers and shakers as far as sectors go. What are you
hmm
seeing as far as some of the money movement?
Yeah, so I was trying to think how I was going to approach this meeting here, and I just figured I'd just reiterate a few things because it's what works best for me over the years, and it's basically just recognizing the market from a strategic perspective, and then recognizing it from a tactical perspective, and essentially that just in layman terms, it just means from a longer term perspective for your investment portfolios from a money management standpoint. And then you have your tactical, which is more of your fun money, short term scalping, day trading, maybe really short term swing trading, overnight trading stuff. Um, and sometimes those are all in line with each other, and then other times they're not. And I would say since this year started, with the volatility spiking, the VIX has been spiking above 20 and even going above 30 on some occasions recently. Um, things become a lot more tactical oriented. Things are moving a lot faster. There's a lot more uncertainty there. Things just kind of change gears on a day-to-day basis. Could look one day it looks like the sky's falling. The next day, you're taking out the previous day's high. So it's really a very short-term oriented market that I think we've been in for the last 6 to 7 weeks here. And I think as long as you recognize those conditions, and I've said this repeatedly on Trader Audio each afternoon, you have to really respect that volatility that comes with the market. And you have to be a little bit more fluid in willing to trade both sides, long and short, in this sort of environment. And you can't really, dig your feet in too aggressively and kind of stand your ground because you will get run over on both sides, longs and shorts. And so you really have to have a better approach to trading. For me, it's been scaling into positions, and whether they're long or short. So what I do is identify either a key support or resistance level. I give myself enough wiggle room, usually about $1 to $2 around these key zones, and I slowly dip my toe in the water, starting off with a quarter, third size, and then maybe I'll add up to about a half a size if I still feel some conviction with it based upon the overall market dynamics. And then pretty much from there on out, I usually don't add, I don't add to a loser beyond a half size. From that point on, there's usually something else, some dynamic that's changing that I'm not recognizing. And I usually don't go above half side under these more volatile conditions. I'll just take the loss at that point. But generally speaking, that approach has worked out very, very well for me. It's allowed me to give the stocks enough wiggle room that they need, given the heightened volatility, and just been able to capitalize on a lot of the turns and the trends and the momentum that's been taking hold there. And I continue to do that. I took a week off, like I said, and I came back, and sure enough, the VIX was at 30 yesterday, and here it is again today at 26. So it still remains my core philosophy for approaching this market on a day-to-day basis, from a shorter term, day trading tactical perspective. From the strategic point of view, the much more longer term point of view, uh, the market, we all know that the market ran up off the pandemic lows from March of 2020, and it had a hell of a good run all the way up until the end of 2021 there. And it was just kind of natural that we would eventually see some sort of corrective move in the market, and that's basically what's this market's been going through over the last couple of weeks here. I don't think we're due for any sort of massive bear cycle or anything. I just think we're long overdue for a rest and a pause. I've mentioned multiple times the one thing I think we're due for is about maybe a quarter or two of sideways choppy range. And I've referenced 2015, the first half of 2015 all the time. It's the closest thing I can recall of where the market really, would go up one week, down the next week, up the next week, down the next week, and it would just be all over the map for 6 months. And I think we're just long overdue, 6 years overdue for something like that. During those time frames, relative strength, relative weakness in the underlying industry groups really play a major role. And it's obviously I stick with trends when it comes to things like that, when it comes to analyzing the sectors and the various industries. And so far to start this year, I mean, we all know that energy It's all energies, commodities, agricultural stocks, anything to do with inflationary costs, are really just kind of where the money's been chasing, to the upside. And that, granted, it might be a little bit too late to kind of go, all in at this point on that stuff, but it's still, those trends are still in place there on a lot of those commodity areas. Aluminum is another area. What else do I have written in here? Copper, mining, gold started to recently catch up. The agricultural names still look pretty good there. A lot of the energy names, they're starting to slow down a little bit. I highlighted that on one of my pages yesterday. But this is like one of the first pullbacks we've seen in a while. So again, these pullbacks should be welcomed in a lot of these groups. I suspect that they're going to be defended with bids somewhere around key support levels, moving averages, etc. So I got to keep those on the radar. And then look at interest rates. Obviously, they've been probing, the 10 year has been probing the 2% level recently. It's been on the rise throughout this year so far. Lots of rhetoric about and talking heads about how many rates are going to be this year to tame this inflation. And that all is basically putting a bid underneath the financial sector as well. It's even been trickling beyond the financials and even moving into some insurance plays as well, as I've noticed. And then you have the rest of the market too, who is maybe being a little bit more defensive. And we have seen a lot of staples, consumer staples, really kind of outperforming everything from tobacco to Procter and Gamble, and your just basic run of the mill household items have just kind of been creeping up there as well. So those are the areas that I think a lot of portfolio managers have shifted to over the last 6 weeks, into those leading inflationary, financial, everything that's going up, trending higher sort of environment. It's a little too early to say if it's overcrowded at this point. Again, I think maybe we're due for some sort of slowdown, some sort of rotation. But overall, those are going to be the more strategic, intermediate to longer term groups that I'm going to be focusing on, or I have been focusing on for my longer term portfolios. So that's the breakdown that I have. I think this market really has to be split into two different approaches. One, that longer intermediate term strategic play, focusing on inflationary and rising rates environment. And then you have your tactical shorter term approach, which really is, just go after any of my trades, go after liquid momentum, the TA page scans. There's just a plethora of opportunities when volatility is as high, long and short.
All right. And so some of the shorter term would be like semiconductors and
Yeah.
names like that.
Yeah, totally. Anything with good volatility. Yeah, you're probably not going to see me, day trading a, Procter and Gamble or a Bank of America or something like that. I'm definitely more of a higher beta, high ATR, trader. I like to get more bang for my buck. So yeah, liquid momentum and any of those names on the TA page scans are definitely in my wheelhouse of volatility.
All right. I'm going to bring in Scalp Trader now. And this guy likes to get some bang for his buck too, but he does it in quite a different way. Damon, how are you this morning?
Hey, I'm well, Jim. How about yourself?
I'm doing quite well. And we had you on yesterday, and you somewhat defended some of your SPAC holdings. And for those who might not have heard that, and kind of the way you strategize around that and looking for some of the distressed plays, why don't you give a little recap of what you're looking for and how you do it?
Well, I'm going to start in a different place because I'm doing something new that I haven't been involved in a little while. So,
Oh, you forgot to tell me that part.
well, so that's all right. So it started today, actually.
All right, let's talk about it.
For several, probably the past, I don't know, 7, 8 years, I've run an income portfolio, really kind of a cash management type of portfolio. Like, I'm a strong believer just with my trading style. I'm usually never fully invested, so I always have excess cash sitting around and have to figure out what to do with it. And I typically invested in high yield securities that are yielding anywhere from 7 to 10%. There's typically quite a bit of volatility in those names. And so My target is an 18 to 20% return between the income that it kicks off and trading volatility. However, with interest rates so low, there was a desperation for yield, and companies were able to issue new paper at 4%, 4.5%. They're able to issue convertible debt at 0% or 1%. So I've stayed away from that market, understanding that interest rates would eventually rise and the prices of those securities would fall. And so now I feel like we're at a point that you can finally start putting some cash back to work. And I've been very cash heavy over the past year just because I had concerns about market valuation, really kind of focused on shorter term opportunities and just being opportunistic about scaling out of positions into upticks and waiting for market declines to reinvest that capital. So today I wanted to highlight a couple of preferreds. The preferred of TRTN, which is Triton. I think it's Triton International.
TRTN, right?
And they are, if not the largest, one of the largest providers of shipping container leasing in the world. So they reported earnings this morning, posted Q4 earnings of $177 million of net income. And that's after paying $53 million of interest and $13 million on the preferred dividends. They also spent about $100 million buying back stock. So the two preferreds that I'm looking at from them are TRTN C, preferred C, and preferred D. The preferred C is yielding about 7.2% right now, which is, 7.2% is hard to find these days. And with the coverage they have, they're paying $13 million a quarter in preferred dividends. Yeah, they're generating after debt and preferred dividend payments of $177 million. They have long-term contracts in place, so they should continue to post outsized earnings for the next several years, or at least the next year. So basically, this is kind of my first foray back into the high-yield preferred market in a couple of years almost. Now, we do still have some legacy positions from that space, and trying to think, we have a number of REIT and I think a couple energy preferreds that have done really well since then, triple-digit gains with double-digit yields. And I don't talk about those much, but I've just kind of been sitting on those names, kind of letting them kick off dividends. And so just in terms of an inflation hedge, having names linked to real estate as well as energy, it's nice to have those in the portfolio sitting on big gains and just continuing to benefit from just kind of being patient and letting those positions ride. So in terms of as you know, I run multiple portfolios, right? So always trying to just kind of maximize opportunity. And so I'm going to go back to your first question about the SPAC plays and the speculative plays. Typically with speculative names, I prefer to buy names on pullbacks that I've done research on, which is not kind of the traditional approach. And sometimes you get your hand burned stepping in there. But just given a market that had continued to reward one for stepping in and buying these names on pullbacks and quickly realizing 75%, 100%, 200% plus gains, you wanted to, it was almost necessary to kind of step to the plate, even though there was a lot of risk involved. So obviously January was one of the most devastating down months in quite some time, probably, I don't know, in terms of a month. I don't know that we've had a down month like that. Obviously we had that during the pandemic, but before that, I don't know if it was since the financial crisis. So I got stopped out of a number of SPAC names and started to reload after some of these things had already fallen 60, 70, 80% off of their 52-week highs. Caught a lot of flack on these names, but I guess with the understanding that the speculative portion of your portfolio, again, it's just a portion of your portfolio. It's not your entire portfolio. And so my goal with these types of positions is to identify names that have the potential to rally at least 50%. But I'm really looking for 100%, 200% on these types of opportunities. So instead of when prices are falling, people get nervous, more nervous, and more nervous. I get more excited, right? So when I'm buying something at a quarter position and it keeps falling, and who knows, maybe I got in a little bit early, but it falls another 50% and I can get a larger position and potentially participate in greater upside. I get excited about that. And I always describe myself as when there's a fire and everyone's running out of the building, I'm always the guy running into the building. And that's where I've done really well, exceptionally well, off the charts well. And so I'll always continue to do that. Been doing it, been in this market for 25 years. And I found that that is the best strategy, at least for me. I'm very comfortable running into fires, and not everyone is. So you have to understand that if you're participating in these types of trades with speculative names, distressed names, SPAC names, value names, sometimes these are long-term plays. But the thing is, and you have to, it requires patience and discipline and a lack of emotion. But the thing to remember is that one of these trades can literally make your entire year. And I've had that happen many times. So that's what I'm looking for, that year-making trade, right? And so hopefully you get more than one of them, but it only takes one. So that's kind of a rundown of the SPAC current situation.
All right. And you tend to highlight some of the other things that you're working on besides these preferreds in TRTN. Anything else back there in the lab?
So I'm actively doing research. As I posted this morning, I think we had approximately 500 new lows to approximately 40 new highs yesterday. So there's a lot of things getting really beaten up. And as I've said before, there has not been a lot of distressed assets over the past couple of years. And I think with rising interest rates, falling stock prices, you're going to start to see more distressed situations. So I'm really starting to research some names in advance that aren't quite distressed, but maybe have the potential to get on the ropes. And so that's part of my process. I'm happy to research a name now that may not get itself into trouble for another 9 months or 12 months. And so now that we're starting to see some of the air come out of the market, I think I'm seeing more opportunities. They're not quite ready to pull the trigger on, but again, lower markets, higher interest rates, lower appetite for risk creates opportunities when people are concerned about companies refinancing debt or running out of money, creates potentially compelling opportunities.
All right, Damon. Does anybody else have anything to add? Maybe a stone left unturned that we didn't cover that you'd like to get out there for our investment community?
Yeah, just two things. This is Blue Chip again. I think Damon made a great analogy there. How he's the kind of personality that likes to run into a fire. And I'll say this, like watching him get involved in preferreds, I think was after the financial crisis where he started to really make a deep dive into these distressed companies and then get into preferreds. I have no background in that. I mean, I've obviously I know what a preferred is. I know they pay more, and you get, in the case of a bankruptcy, you get paid out before the common share stockholders and stuff like that. But that was like the limited amount of knowledge that I had, and I just kind of watched him do his research over the years, and it took me a while to dabble into that realm and to put that away, because it is something new, I think, for a lot of people. And again, don't just piggy. I guess my point I'm trying to make is, just because we post something and we're comfortable with it and we can get involved in something, if it's new to you and you're not familiar with it, dip your toe in and or monitor the price action or watch our trades and see how we handle it. Like, really, it should be a learning experience and not something that you just blindly copycat on our part of things. If you don't clearly understand what's going on, it's just going to be way too much risk, and you're not going to be able to handle the the volatility or the length of time that comes for it. You're really going to be better off always just kind of slowly dipping your toe in and piggybacking. And, like, for example, Damon's a big guy. If he runs into a fire, I'm going to let him go first and really kind of be hiding right behind him, like really cautiously. I'm not going to be right next to him on his side or leading the way in. So it's just definitely something that I would just highly recommend if you're new to this. And this goes for all of our trades too. Chart Trader trading futures, Greg doing his longer term position trading, et cetera, and even my shorter term day and swing trading. If you're just not familiar with that sort of style of trading, or you're interested in it, just really go at your own pace and do what's comfortable, that suited for you. Last point I wanted to make too. I got back in time for my vacation for the Super Bowl, and does anyone else feel I don't know if I'm sure you all watched it, but does anyone else feel that there's like a massive demand for the whole world to get involved in cryptocurrency? It seems like they're cramming it down our throat. And anybody that listens to me on Trader Audio, I sometimes talk about that sort of behavioral financial approach to the markets. And I get really, really concerned when the crowd and the celebrities and everybody else is telling me I have to get involved in something. And, I look at the charts and I look at everything else in cryptocurrency. And again, not talking short-term day trading and stuff like that. Obviously, there's plenty of volatility around there and everything else. And from a longer-term perspective, I understand them. I understand the technology is incredible for blockchain, and it's going to have this really big, long future. There's just something that doesn't sit right with me from a behavioral, psychological perspective when I have so many commercials crammed down my throat to tell me that I have to be involved in this. Does anyone else feel that way? Do you see where I'm coming from? Or do you,
Yeah.
feel free to argue against me.
I mean, Scott, I usually have the same sense, and I feel like, I saw that with the DraftKings and those guys, 2-3 years ago,
Right.
Literally every commercial during like an NFL broadcast,
right, I remember, yeah,
DraftKings or whatever, all the other different companies, and you're like, okay, this is going to end really badly. But I think with cryptocurrency, I feel like in terms of kind of the intermediate term peak of interest, I feel like we've already hit it. I mean, again, I have a high schooler, and I can't tell you how many of his friends, while they were out of school, learning from home, they were trading cryptocurrency. I mean,
right.
Literally, I'd say 80% of them were trading cryptocurrency.
Right. I think maybe, I guess a good way to look at it is, since I started this business back in the mid 90s, during the late 90s, 2000, there were so many internet stocks out there that were just rip roaring to the upside, and the hype was there big time. But then after it came crashing down, only a few eventually emerged as the leaders, the Amazons and the Pricelines, et cetera, 2-3 years after that massive correction. So, yeah, I guess that's the best way to look at it then. I guess we could kind of say that we're in this intermediate peak that happened a couple months back. And, I think only the true leaders are going to eventually emerge, but something still doesn't sit right with me just yet.
Let me offer a different point of view, slightly.
Sure.
And I don't know if I can back it up, but it occurs to me listening to your conversation. And that would be, there's a limited demographic realm right now where cryptocurrency is penetrated. And there's a great, vast, open countryside of people who probably haven't been in any way involved. And they're probably unlikely to become day traders, but still a legitimation process of a much more mainstream version of this entire phenomenon is possible. And what I think we've seen is there's a lot of people with significant interests, deep pocketed, hodling interests in cryptocurrencies that have all become much richer over the last 2 years. And suddenly they're able to hire Matt Damon to do long commercials, which during very mainstream events, which seems to me like a recipe to possibly legitimate it more on a mainstream level and involve different demographics.
Yeah, yeah, no, I hear you. I mean, it goes back to even that one commercial that they had for Coinbase. I think it was just the QR code that was just bouncing around the screen for a minute. I mean, at first I'm sitting there going, what is this commercial? And then my teenager was basically like, oh, I gotta figure out what this is. So he shot at the QR code with his phone, and he's like, oh, it's a Coinbase website, which is actually brilliant from a commercial marketing standpoint. That's the first commercial I've ever seen where they've actually forced people to go directly to their website. That is insane. If I was a marketing person, I'd be doing that for everything from now on.
I would never end up on your website.
Well, but it goes to your point, the demographic. I think,
Yeah.
Brett. I think we're past that generation where, as the younger generations we're already on top of it and already had that photo already onto their phone. I mean, it's so again, it's just maybe it's just
Well, it's
maybe
not through lack of technology. I just hate commercials. I'm done. I'm not going to sit there participating in your game.
I thought I was just getting older, and then
Well,
not keeping up.
apparently they had to throttle back traffic. They had so many people coming to the site that the site
Yeah.
almost crashed.
Yeah. Anyway,
So
all right,
it
just
was
my
like-
thoughts, throwing it out there. I'm like I said, I'm gonna eventually trade these things. I'm a chartist, so I'm gonna be just watching those trends and those turns and everything.
Well-
But it just didn't sit right with me at all.
Well, one name to keep an eye on that I'm still watching and have been involved in is CND, Charlie Nancy Dave, Concord Acquisition, which is merging with a company that has it's kind of like the money market account of cryptocurrency, and it's like I think the second biggest player now. So when you're trading in and out of cryptocurrency and you want to sit in a cash option that's not cash, I think theirs is what is it?
USDC.
USDC, which Craig knows this name. They're managing about $40-50 billion now.
Yeah.
Is that right, Craig?
Yeah, I think it broke 50 billion. Yep.
So with interest rates going up as well, like the money they're going to make on the spread kind of explodes. So it's kind of a financial crypto infrastructure kind of play that once the merger is completed, it could be an interesting move.
Yeah, I'm still in that, and CND, which again is a play on USDC, a stable coin that's technically still a little smaller than Tether USDT, but it's growing a lot faster and has some more legitimate or less shady aspects to it. I'm just hoping the SPAC deal actually closes. It's been a while. So hopefully that actually does happen, because I do think that will be a nice opportunity. Sticking with the crypto theme, if we're just talking about Bitcoin, do I think that it makes sense to have some exposure here after this 50% pullback? For the long term, sure. It's the digital gold store of value, but again, central banks devaluing your currency, etc. But the price action in the last even week or a few months has kind of really exposed the fact that it still is just a very speculative asset that's going to see the same kind of volatility as stocks. So, I view it as the same culprit in terms of less liquidity and money sloshing around. So, does it make sense long term? Sure, but it could continue to fall because it is a very speculative asset, obviously. One other thing I did want to mention, I failed to kind of touch more on Roblox, which also reports this afternoon. The engagement trends are probably going to be more important than the financial results themselves. I bought this one right around I believe it was a direct listing, not IPO. and it basically doubled. And now I made my first purchase since I think it was the day of the direct listing a couple weeks ago. Soon after it hit a new low. If the engagement trends continue to sour, I believe January there's the seasonal impact is going to be softer from December. This stock could get hit if the engagement trends disappoint, because they do, along with Q4 results, they'll disclose January user bookings and user growth and all that. So, this stock could get hit. It's not cheap at like 50 something times EBITDA, but they are generating cash. It's profitable. They're investing a ton in R&D because they want to maintain the leadership as really the only true metaverse play out there. You're seeing more and more companies, building their own experiences in Roblox. It's sort of like Airbnb. If it does get hit, and it could because it's not a cheap stock, I think it's just going to create more opportunity to buy the weakness, because we all saw what happened with this stock back in November, and obviously the market is very different than it was before Powell pivoted and the Fed no longer has our back. But that metaverse theme, while very much overhyped late last year, is not going anywhere, and this remains kind of the best way to play it. So that'll be another interesting one that's out this afternoon.
Hey, well, I have a quick question for you guys. I'm always trying to look at new trends and find opportunities. NFTs, while we're on the discussion of cryptocurrencies, I've done some research and I really just can't get my arms around it. It just feels like a big scam to me. But I don't know. Maybe I'm missing something.
Would you just join my world?
Yeah.
Look at the ETF. Look at the ETF when it came out. NFTZ. Nancy Frank. Nancy. Oh yeah, that was the top. Gavin and I talked about it all the time. NFTZ. Nancy Frank Tom Zebra made its debut end of November, and it basically put the kibosh on the whole thing, as most of these thematic ETFs usually do. Started to turn around a little bit, but I don't know. Again, it's probably.
I tend to side with the South Park view.
Which is what? How'd that go?
Oh, you didn't see the? Oh man, it's hard to describe. Butters becomes the greatest NFT salesman ever in the future, and he's just a pure crazy con artist, and it's awesome.
Yeah. Again, it's a good trading vehicle, but I don't know. We'll see about the.
Yeah. I kind of feel like these trades, like these big trades that are going off in terms of NFT purchases, are like fake, right? Like they're related party transactions just to kind of get media coverage and these prices. So I just can't imagine with people really paying tens of millions of dollars for something like some silly picture of. So yeah, I don't know.
Yeah, I tend to generally agree. It all seems very crazy, and especially when you're used to looking at stocks, equities from an investment perspective, where the value is in terms of like profitability, and we're just talking about pictures, joining some club. It all seems kind of like a joke, but at the same time, I would not be like. It's much like the crypto market itself. It's just like this new frontier of, I guess, investing or speculating, or even call it just collectibles and trading. And I don't get it personally, but I don't think it's going to be going away anytime soon. Would it surprise me that the whole market collapsed another 50% from here? No, not at all. But I don't know.
As an alternative asset class for people to get involved in, it makes sense from that perspective for me. Right. Because again, artwork is usually considered to be one of those categories and stuff. And I guess if this is one easy way, a more liquid way to get involved in, something like artwork as an alternative asset class to invest in, that's fine. But if you ever do any sort of portfolio management, portfolio theory, or anything else like that, these alternative investments usually represent less than 5 to 10% of a portfolio. So I guess it's really a speculative sort of sort of thing, you know.
I would assume if there's a growing relevance, it will have something to do with how it's a tokenized version of buying real estate in the metaverse, and avatar existence
That I don't get
in
at
the
all.
metaverse. Well,
That's a whole
you'd
different
need,
discussion.
that would be entirely transacted, as I understand, in the form of some
Well,
derivation on the NFT concept.
Yeah, I mean, it all comes back to NFTs kind of enable an ownership within
Digital real estate and
exactly
digital goods.
the digital world. And if you have kids that play Roblox, you can maybe understand better. Okay, well, all of a sudden my kid he's got this whole big ring that he's running within Roblox, and he's making money off of it. And you know what? Whether it's a game or some kind of property that's being built and people are buying. Yeah, I mean, it's just a whole new frontier. So, yeah, it all seems kind of crazy, but Roblox is the best way to play this. I've never seen in the market. Sorry, I can't help but plugging the stock again, but if Unity in terms of its ticker symbol U kind of is behind a lot of digital creation, not only movies, but video games, or the metaverse. And Roblox is really the only leading commercialized metaverse out there that's making money. And it's basically a big video game. So we all know the long-term trend in video games. You look at the round trip, yes, the stock got way ahead of itself, but I think weakness in Roblox is providing an opportunity.
All right, gentlemen. Well, does that wrap up our alternative investment category?
Sure, why not? Yeah.
All right. All right. Fair enough. Well, if there's nothing else from you guys, then we will wrap this up for our February strategy meeting. I want to thank everyone for pitching in and joining us. And hopefully, we'll have the recording out there in the not too distant future. But once again, thanks, gentlemen, for joining me. And we'll look forward to our series next month.
All right, thanks a lot, Jim.
Yeah, thanks, Jim.
All right. Thank you.